Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get right into it. For decades, whenever you heard the name Warren Buffett, there was another name right there beside him, the brilliant Charlie Munger. Now, if Buffett was the friendly teacher, you could say Munger was the master architect. He was the mind behind this incredible mental framework that took good ideas and turned them into phenomenal results. So today, we're going to unpack that very framework, the Munger method.
You know, this single quote, this is the key to unlocking everything about Munger. Think about it. Most people, especially in finance, are desperately trying to be the smartest person in the room. But Munger, he just flipped the whole problem on its head. He focused on one thing, identifying and avoiding common mistakes, what he called folly. His entire system is built on this ridiculously simple foundation. You win by not losing.
Here's the hard truth, right? Most people who try to actively invest, well, they just don't do very well. They actually underperform the market. So why is that? It almost always comes down to emotion. They get swept up in the excitement and buy high because they're terrified of missing out. And then they panic and sell low when fear takes over. They follow the herd. And as Munger loved to point out, following the herd guarantees you one thing: average performance at best. But Munger had a clear set of principles to solve for this.
So first things first, we have to understand the game we're actually playing. Why is investing so incredibly difficult for so many people? Munger was a huge believer that you absolutely have to face the cold, hard reality of a situation before you can even dream of succeeding in it. And this quote just nails the core problem so perfectly. Once you factor in all the fees, the commissions, the costs of trading, investing actually becomes what's called a less than zero-sum game. What does that mean? It means for every winner, there has to be a loser. It's not a friendly game where everyone gets a trophy. Just admitting to yourself that you're playing a difficult game, a game where the odds are kind of stacked against you, well, that's the first, most crucial step toward tilting them back in your favor. Okay, so let's move on to the very first principle. This is something Munger learned from his own hero, the legendary Ben Graham. This is the absolute bedrock of value investing. It's the starting point for everything. This right here is the fundamental shift in mindset you have to make. A stock isn't just a lottery ticket. It's not some little blip on a screen that you hope goes up. It is a fractional ownership in a real, living, breathing business. I mean, think about it. You would never buy the corner store in your town without understanding who its customers are, what its competition is like, and how much cash it's making. Munger believed you should apply that exact same common sense logic to the stock market. And this brings us to a really critical distinction. You have to ask yourself, are you an investor or are you a speculator? See, an investor analyzes the real underlying value of the business itself. They're asking, what is this company actually worth? A speculator, on the other hand, is just trying to guess the psychology of the crowd. They're asking a totally different question. What is someone else going to pay me for this piece of paper tomorrow or next week? Munger was only interested in playing one of those games. And this is exactly why that distinction matters so much. Speculation is a herd game, through and through. You're just trying to guess what everyone else is going to do. And if you're following the herd, by definition, you can never, ever beat it. Munger's entire approach was the opposite. It was about thinking independently, with your feet planted firmly in the reality of the business. Okay, so if principle number one is all about what to buy a piece of a great business, then principle number two is all about how you buy it. This is the value investor's ultimate defense mechanism against a world that's full of uncertainty, human error, and just plain bad luck. This idea, the margin of safety, is something Munger got from Ben Graham, and he said it's one of those ideas that will never be obsolete. It's actually pretty simple. You do the hard work to figure out what a business is worth, and then you insist on buying it for a whole lot less than that number. That discount, that gap between value and price, that's your protection. That's the cushion that ensures that even if you're a little bit wrong in your calculations, you don't get completely wiped out. I absolutely love this analogy from Buffett because it makes the whole concept crystal clear. You don't build a bridge that can just barely hold the weight of the trucks, right? No way. You over-engineer it for safety, for a huge margin of error. Well, in investing, that load on the bridge is all the uncertainty of the future. And the over-engineering, that's the discount you demand. That margin of safety is what lets you sleep at night. This brings us to what is, I think, maybe the most powerful and useful metaphor in all of finance. If you're going to have to deal with the wild swings of the stock market, you need a mental model to handle it without going crazy. And Graham and Munger gave us the perfect one.
So I want you to imagine you have a business partner. His name is Mr. Market, and he's manic depressive. He's just all over the place. Some days he shows up at your door totally euphoric, convinced your little business is the greatest thing since sliced bread, and he'll offer to buy your shares for way, way more than they're worth. Then, on other days, he's completely despondent. The world is ending, everything is terrible, and he'll offer to sell you his shares for pennies on the dollar. The key insight here is this: Mr. Market is there to serve you, not to guide you.
And here is the practical application of that whole idea. You use Mr. Market's wild mood swings to your advantage. When he is terrified and offering you incredible bargains, that's when you get greedy. And when he is euphoric and offering you absolutely silly prices for your shares, that's when you get fearful, and maybe you sell to him. You never ever let his emotional state dictate your own. And now we get to the fourth principle. And I gotta tell you, this is the one that holds the entire system together. It's the engine that powers the other three. Seriously, without this one, everything else just falls apart. What I find so striking about this is just how direct and simple it is. When he was asked for the secret, the one quality behind his success, he didn't say, "I'm a genius," or "I have a fancy degree," or "I know the right people." He just said, "I'm rational." It's the ability to see the world as it actually is, not how you wish it were, and to make your decisions based on facts and logic, not hope or fear. For Charlie Munger, being rational wasn't just a good idea or a nice-to-have skill. He literally viewed it as a moral obligation. He felt you have a duty to be as unstupid as you can possibly be. And here's the kicker: it's not some gift you're born with. He called it a trained response. It's a muscle. And like any muscle, you have to build it through constant work, through practice, and through constantly correcting your own mistakes. So that leads to the big question, right? How in the world do you build that rationality? How do you train that response? Well, this is where we get to Munger's real secret sauce. This is the big idea he's most famous for.
This is what he called the man with a hammer problem. You know the old saying, if the only tool you have is a hammer, every single problem starts to look like a nail. Well, if you only think like an economist or you only think like a psychologist, you're going to twist and torture reality to fit your one single way of thinking. Munger's solution was to build a massive toolbox of mental models, the big, timeless ideas from all the major fields of human knowledge.
And the cool thing is, Munger gives us a roadmap. First, you have to read. You read voraciously to learn the big ideas. Not just from finance, but from physics, biology, psychology, history, you name it. Second, you can't just memorize them like isolated facts for a test. You have to hang them on what he called a latticework of theory in your head, so they all connect and interact with each other. For instance, understanding feedback loops from engineering helps you understand market manias in finance. And finally, when you face a tough problem, you don't just grab one tool. You run that problem through your whole checklist of models to see it from every possible angle. So let's be really clear here. We've been talking about this through the lens of investing, but Munger's system, owning the business, demanding a margin of safety, mastering your emotions, and building that latticework of wisdom, this isn't just some financial strategy. It is so much bigger than that. It's a universal framework for thinking clearly. It's a system for making better decisions in any part of your life, period. And, this quote really sums up the whole spirit of Charlie Munger. He spent his entire life gathering up all this wisdom, not just to make himself rich, but because he genuinely wanted to share it. He truly believed that the highest thing you could do in life was to help someone else become a little less foolish, to give them the tools to think more clearly for themselves. And that leaves us with one final, very practical question. We all face huge decisions, right? About our careers, our relationships, our health, the stuff that really matters. Munger gave us a powerful, proven system for making these high-stakes choices with a clear head. The real challenge he leaves for every single one of us is, are we actually using it? So let's jump right in. What if I told you the real secret to being a great investor isn't some crazy complex formula that only a math genius could figure out? What if it's actually simple? Today, we're going to get into the mind of Charlie Munger, one of the greatest investors of all time. He believed the whole financial world tries to make things complicated on purpose. We're going to peel back all those layers and find the powerful, simple truth at the core of his thinking. To kick things off, you've probably heard this classic story. In the middle of the space race, NASA spent millions, literally millions of dollars and years of research to invent a pen that could write in zero gravity. An amazing piece of tech, right? Meanwhile, the Russians, they just used a pencil. This story is the perfect example of a core Munger idea. We get so wrapped up in finding complicated solutions that we completely miss the simple, obvious answer staring us right in the face.
All right, so here's the game plan for today. First, we'll tackle what Munger called the complexity trap. Then we'll get into his brilliant decision-making system, the 3 baskets. After that, we dive into maybe his most important idea, the art of not stupid. We'll talk about why this simple stuff is so darn hard to do in real life, look at the 2 paths he says exist for every investor, and then we'll finish up with the Munger test. And, spoiler alert, it has nothing to do with your IQ.
Okay, section 1, the complexity trap. You have to understand the entire value investing system, the one that Benjamin Graham started and that Munger and Buffett perfected. It was built to be simple on purpose. Munger felt that we, especially those of us in the world of finance, have this really dangerous tendency to overcomplicate everything. And this quote right here, this really nails it. Being simple isn't about being basic or lazy. No, it's the total opposite. It's about getting to such a profound level of understanding that you can just cut away all the fluff. Because when you really, truly know what you're doing, you don't need all the jargon and the complicated models. You can focus all your brain power on what really drives the bus. And that, according to Munger, is how you really improve your results.
So you might be asking, okay, that sounds great in theory, but how do I actually do it? Well, Munger had this beautifully simple framework he used for every single investment idea that crossed his desk. He called it the 3 baskets. You can think of it as the basic operating system running in the background for a true value investor. And here they are. First, you have the in basket. These are the absolute no-brainers, the slam dunks where you have a real verifiable edge. Then you've got the out basket. These are the easy passes, the quick no thank yous. But the most important basket, the one that holds almost everything, is the too tough basket. And that's the magic right there. It's a mental filter. It stops you from wasting your limited time and energy trying to figure out every single puzzle. You save it all for the handful of decisions that really truly count. And here he is, saying it himself. He's not trying to be the guy who solves the hardest problems in finance. He's looking for the easy ones. The whole financial industry is built on the idea that you have to be a genius who can analyze anything. Munger says that's just crazy. Your only job is to figure out which games you can actually win and then have the discipline to ignore everything else. And this all feeds into Munger's definition of what he called real knowledge. You see, it's not about how much you know. It's about knowing the exact border of your own ignorance. I love this analogy he used of a tightrope walker. How does someone do that for a living for 20 years and not, fall? It's because they know with absolute certainty what they can do, and even more importantly, what they can't. They never, ever guess, because the consequences are, final. For an investor, the stakes are your financial future. Okay, let's shift gears now to what I think is Munger's most powerful and definitely most unconventional idea. He called it inversion, but we're going to call it the art of not stupid. And it's basically flipping the way you think about solving problems completely on its head. So, if you ask this question to a room of aspiring investors, what are they going to say? They'll talk about finding the next Amazon, about super complex analysis, about trying to outsmart everybody else in the market. Right. The default setting for most of us is to aim for brilliance. How can I be the smartest person out there? How can I be more clever than the market? It seems logical, but Munger would say it's a deeply flawed way to approach the game. And boom, here's the Munger flip. Instead of asking, how can I be brilliant, he would ask, what are all the dumb things I could do here, and how can I just avoid doing them? By just methodically avoiding the big mistakes, like overpaying for a stock, getting swept up in a speculative bubble, investing in a business you don't get, you almost automatically end up way ahead of the person who's just trying to be a genius. It's like he said, it's the strong swimmers who drown. They take risks the rest of us won't. Now I know what you're thinking. This all sounds so logical, right? So simple. Which begs the question, if the secret is just avoiding dumb mistakes, why isn't everybody rich? Well, the answer is that the biggest roadblock isn't the stock market. It's us. It's that person we see in the mirror every morning.
Munger loved telling stories to make his point, and this one is just perfect. So an investor is walking in a park, and she finds a frog. The frog looks up at her and says, "Hey, listen, I used to be a stock speculator, but a client I lost money for put a spell on me." The frog goes on to explain that if a true investor kisses him, the spell will be broken. So the investor, she thinks about it for a second, then just picks up the frog, pops him in her purse, and keeps walking. The frog, totally confused, pokes his head out of the purse and says, "Hey, what gives? What about the kiss?" And the investor says, "Look, you're worth a lot more to me as a talking frog than you are as just another stock speculator." She saw the rare, durable advantage, a talking frog, and she refused to trade it in for the highly uncertain outcome of getting one more speculator in a world already full of them. And that right there is the real punchline for all of us. This simple system is so hard because it often means you look foolish in the short term. While everyone else is getting rich off the latest hot stock, the value investor's just sitting there, patiently holding their talking frog. You have to be okay with underperforming in a crazy bull market so you can protect yourself when things eventually turn south. And man, that takes an incredible amount of psychological strength. Okay, let's bring this down to earth. What does this actually mean for you and your money? Well, Munger believed that for pretty much everybody, there are really only two logical paths you can take as an investor. Let's break them down. But first, you gotta hear this other Munger classic. A guy walks into a tackle shop, sees these ridiculously looking purple and green fishing lures, and asks the owner, "Do fish actually bite on these things?" And the owner says, "Mister, I don't sell to fish." The point is, so much of the financial industry is selling complicated stuff that appeals to investors' emotions, not what's actually best for them. So here are the two paths. On one side, you have the active investor. Their whole goal is to beat the market. Munger thought, yeah, it's possible, but only for maybe the top 3 or 4% of people, the ones willing to put in a massive amount of time and who have what he called mutant-like emotional control. And then on the other side, you have the index investor. Their goal isn't to beat the market, it's just to be the market. They accept their own limitations and spend almost no time on it. Munger said this was the best path for what he bluntly called the know-nothing investor. And let's be super clear here, when he says know-nothing, that's not a put-down. It's just his way of describing someone who doesn't have the time or the personality or the deep knowledge of business to be a professional stock picker. And for that person, which, let's be honest, is most of us, his advice never changed. Just buy a low-cost, diversified index fund and then go live your life. It's like Buffett said, when dumb money acknowledges its limitations, it ceases to be dumb. And that brings us to the grand finale, the Munger test. Because after all of this, the thing that will ultimately decide whether you succeed or fail as an investor, it's not your smarts or your fancy degree, it's a test of your character. Munger called this essential skill a trained response. And this is absolutely critical. It doesn't matter if you're an active stock picker or a passive indexer, you need this skill. It's the ability to feel that fear when the market is crashing or that greed when it's soaring and then not act on it. It's about training yourself day in and day out to not become your own worst enemy. So we'll end with this question, built on Munger's absolute favorite analogy. Investing, he said, is like baseball, but with one huge difference. There are no called strikes. You can stand at the plate and watch thousands of pitches go by, high, low, inside, outside, and it costs you nothing. You never have to swing. Your success comes down to having the discipline to just wait and wait for that one perfect pitch right down the middle in your sweet spot. So the question I'll leave you with is, do you have that patience?
All right, let's dive right in. Today, we're getting into the mind of the legendary Charlie Munger to really unpack his powerful, time-tested philosophy on investing. Now, this isn't about risky predictions or some crazy complex algorithm. It's a system built on just four clear, profound principles that, I promise you, can totally change the way you think about the market.
You know, it's a fair question. I think we've all asked it at some point. You see the market jumping up and down every day, and it's so easy to just see it as this giant global casino. But Charlie Munger's entire method is built on just a complete rejection of that idea. For him, there's a massive difference between real investing and, well, just speculating.
And this right here is the key that unlocks the whole thing. Munger's #1 idea. Forget the ticker symbols, forget the little squiggly lines on the chart for a second. Before you do anything else, you have to get this in your head. When you buy a stock, you are buying a tiny piece of a real, living, breathing business. That single mental shift, it changes the entire game.
So here's our roadmap for this explainer. We're going to start by drawing a really hard line between investing and speculating. Then we'll walk through each one of Munger's 4 core principles. And we'll wrap it all up with the ultimate challenge that this system presents to, well, every single one of us.
Okay, first up, you have to understand that there are 2 totally different games being played in the market at any given time. You have to decide which one you're playing because the rules, the mindset, and believe me, the outcomes are worlds apart.
What's so great about this is how it all boils down to the question you're asking yourself. An investor, they're like a business analyst. They're digging through the fundamentals, asking, if I were to buy this entire company right now, what is it actually worth? The speculator, on the other hand, is trying to be a mind reader. They could care less about the business, they only care about the price. They're asking, what's the crowd going to pay for this tomorrow or next week? See? One game is about value, the other is just about guessing.
There's this fantastic story that just perfectly illustrates the madness of speculation. Picture this. A man shows up in a village and says, hey, I'll pay $100 for every single monkey you can catch. The forests are packed with them, so the villagers think this is the greatest deal of all time, and they get to work catching thousands of these monkeys.
So eventually, the monkeys get harder to find. The man raises his price, then says he's got to leave town for a bit, but he promises he'll be back to buy monkeys for a crazy $500 each. While he's gone, his assistant pulls the villagers aside and says, listen, I'll secretly sell you the monkeys we already have in these cages for $350. When my boss gets back, you can sell them to him for $500. Well, the villagers, just blinded by greed, they pool all their life savings and buy every last monkey. And of course, they never see the man or his assistant again. They weren't investing in the value of monkeys, they were betting on what someone else would pay.
And that little story is the perfect lead-in to the first principle, which is really the antidote to that whole speculative mindset. You have to treat every single share of stock as if it's your proportional ownership in an actual business. This isn't just some clever phrase, it's the foundation for everything that comes next.
So what does that actually look like? Well, it means you basically become a detective. You do a bottom-up analysis. You're not worried about broad economic trends. You're looking at the company itself. How much debt does it have? Are profits growing? Does it have a real competitive advantage? You care about its history, not what some analyst on TV is forecasting. And Munger is famous for this next part. You have to be brutally honest about what you don't know. If you can't figure out how a business really makes its money, you don't guess. You just put it in what he called the too hard pile and you move on. And there's zero shame in that. In fact, that's what true discipline looks like.
This quote from Jason Zweig just nails it, doesn't it? The key thing to get here is that the business has a real intrinsic value, and that value exists completely separate from its stock price on any given day. The price is just what people are willing to pay for it at that moment. The value is what it's truly worth. An investor's job is to figure out the value.
And that whole idea of knowing a company's true value leads us straight to the second principle. Because once you've estimated what a business is worth, you then have to demand a margin of safety. Think of this as the non-negotiable bedrock rule that protects you from a world that is, by its very nature, unpredictable. It's basically an engineer's approach to finance.
And hey, this idea comes directly from the father of value investing himself, Ben Graham. He said if you had to boil the entire secret of sound investing down to just 3 words, these would be it. So this isn't some newfangled idea, it's a principle that has worked for nearly 100 years.
So what is it exactly? It's really simple. It's the gap between what you think a business is worth, its intrinsic value, and the price you actually pay for it. It's buying a dollar for 70 cents, or 60 cents, or if you're lucky, even less. That discount, that's your cushion. It's your protection against the unknown.
To make this really concrete, let's use a brilliant analogy. Imagine you're an engineer and you're building a bridge. After you do all your calculations, you figure out this bridge has to be able to hold a maximum weight of 30,000 pounds. That's its absolute limit.
But then, when you open the bridge to the public, you put up a big sign that says, maximum load, 10,000 pounds. You only ever let 10,000-pound trucks drive across it. That huge 20,000-pound difference between what the bridge can handle and what you actually put on it, that is your margin of safety. It's a fantastic way to think about it.
And why do you do this? Why insist on such a huge buffer? Because it means you don't have to be perfect. The world is a messy, complicated place. You are going to make mistakes in your analysis. Bad luck is gonna happen. A margin of safety makes sure that even when you're wrong about a few things, you can still come out okay. It's your ultimate defense against a future you can't possibly predict. This leads us right into the third principle, which requires one of the greatest mental models in all of finance. You have to learn how to deal with your imaginary business partner, the one Ben Graham famously called Mr. Market. And I'm telling you, this partner, he is very, very moody.
Munger just loved this metaphor. Imagine you co-own a business with this guy, Mr. Market. Every single day, he shows up at your door and he's in a completely different emotional state. Some days he's just terrified and depressed. On those days, he's screaming, "The sky is falling, I'll sell you my half of our great business for a ridiculously low price, way less than it's worth."
But then, other days, he shows up totally euphoric, just giddy with optimism, and he's yelling, "This business is the greatest thing in the history of the world. I have to own more. I will buy your share from you for a price that's way, way higher than you ever dreamed of." Your job is to completely ignore his emotions, stick to your own analysis of the business's value, and simply take advantage of his crazy offers. You use his depression to buy cheap, and you use his euphoria to sell dear. You make him your servant, never your master.
And of course, Warren Buffett's famous line is the perfect way to sum up this entire principle. When Mr. Market is greedy and euphoric, that's when you should be fearful of his high prices. And when he's fearful and depressed, offering you incredible bargains, that is your moment to be greedy. It sounds so simple, right? But it's one of the hardest things in the world to actually do.
And that difficulty, that brings us to the fourth and final principle. This is the one Munger believed was the most important of all. It's the master key that locks the entire system together. You must be relentlessly, almost inhumanly rational. Now listen closely to the words Munger uses here. He calls it a binding principle, a moral duty. For him, rationality isn't just a clever trick to get rich. It's an ethical obligation you have to see the world as it actually is, not how you wish it were. It's about actively fighting all the emotional and psychological biases that are hardwired into our brains and lead us astray. So, let's just recap the entire system. It's 4 simple, powerful ideas. Number 1, a stock is a piece of a business, not a lottery ticket. Number 2, build a bridge for 30,000 pounds, but only drive 10,000-pound trucks across it. Always insist on a margin of safety. 3, let Mr. Market's mood swings serve you. Don't ever get swept up in them. And 4, the master key that holds it all together. Be objective, be dispassionate, and be relentlessly rational. And that brings us to the final and most crucial point of all, the Munger method. It's not intellectually difficult. The principles are clear, they're logical. The real challenge isn't in understanding the system, it's in actually doing it. This is a test of your temperament, not your IQ. You now know the rules of the game. The real question is, can you master the one player who is most likely to make you lose? Yourself. All right, today we are going to dive deep into the mind of an absolute legend, Charlie Munger. We're going to unpack a huge paradox that he obsessed over his entire life, and we'll break down his incredible solution for it, this idea he called worldly wisdom. Let's jump right in. So, Munger kicks things off with this question right here. And you got to admit, it's a great one, isn't it? Because we have all seen this happen. You see these brilliant people, experts, leaders, maybe even ourselves sometimes, making decisions that, when you look back, seem completely nuts. So what is going on here? Well, Munger had a diagnosis. And this is it. This quote is the heart of Munger's insight into why smart people fail so spectacularly. They get so specialized, They get so good with their one single tool, their hammer, that they start trying to solve every single problem with it, whether it's the right tool for the job or not. He called this the specialist trap. Munger often pointed out that a lot of academics or highly trained professionals, say a poetry professor or a classically trained economist, can be, in his words, unwise in a worldly sense. And why is that? It's because they just don't have enough different ways of looking at the world. They don't have enough models in their head to see reality for what it really is. Now, what's really fascinating here is the psychology behind it that Munger highlights. This isn't just about an intellectual blind spot. Oh no, it's way deeper than that. It's a fundamental human tendency. We will literally bend, twist, and, as he puts it, torture reality, just so we can cram it into the one framework we're comfortable with. It's a powerful cognitive trap, and it's incredibly hard to see when you're in it. Okay, so if being a narrow specialist is the problem, what's the solution? The great thing about Munger is that he didn't just point out the issue. He came up with this powerful, really elegant framework for thinking better. And that's this concept he called
worldly wisdom.
At its core, worldly wisdom is all about breadth, not just depth. The goal is to collect the really big foundational ideas from a ton of different fields. And Munger believed that when you start combining these models, they don't just add up, they multiply. They create this synergistic effect, an understanding that is so much richer and more accurate than what any single discipline could ever give you on its own.
So let's nail this down. What exactly is a mental model? Well, just think of it as a big, important idea from a specific field that helps you make sense of the world. The theorist Herbert Simon described it perfectly here. It's not some fuzzy, vague intuition. It's a real, concrete toolkit in your head, a collection of patterns, checklists, and potential moves that an experienced thinker can pull from at any moment.
And this brings us to Munger's absolute killer metaphor, the lattice work. He says that facts, on their own, are pretty much useless. You need a structure to hang them on so they can connect and actually mean something. That structure, that is your lattice work of mental models. And every new model you learn doesn't just add a new point, it strengthens the entire structure.
So where do you go hunting for these models? Well, Munger believed you had to cast a really, really wide net. You've got to understand the big ideas from all the major disciplines. For instance, knowing about compound interest from math is obviously crucial for finance, right? But it also applies to building habits or growing your knowledge, or understanding natural selection from biology. That helps you understand competition in business. And getting a handle on cognitive biases from psychology, well, that helps you understand why you do irrational things. You don't need to be a PhD in every field, but you absolutely need their foundational principles in your toolkit.
Okay, let's look at a real-world example from Munger himself to see how powerful this is. An economist sees a product that starts selling more after its price goes up. The economist says, nope, impossible. That violates the fundamental laws of supply and demand. But the worldly wise thinker, the one with multiple models, sees a whole range of possibilities. Maybe a psychology model's at play here, where a higher price signals higher quality to the customer. Or perhaps it's a luxury good, where the high price is part of the appeal. Or, as Munger actually found in one real case, it was all about incentives. The seller was secretly bribing the buyer's purchasing agents. You see, a single model leaves you blind and confused, but multiple models reveal the truth. It's brilliant. This all sounds amazing, right? But here's the catch. It does not happen by accident. You can't just passively absorb this kind of wisdom. You have to actively and intentionally build it. Munger believed you literally have to turn yourself into what he called a learning machine.
Oh man, I love this quote. It's so hopeful and so true. It's not about having the highest IQ. It's about relentless, incremental progress. The key word here is consistency, the commitment to go to bed every single night just a little bit wiser than you were when you woke up. Over a lifetime, that's the engine that builds your lattice work.
So how do you actually do it? Well, the sources lay out a pretty clear 4-step playbook based on Munger's own habits. Number 1, read. A lot, voraciously, and this is critical, read way outside your own field of expertise. 2, and this one is so underrated, you have to actually schedule time just to sit and think. Embrace solitude. 3, don't try to reinvent the wheel, master the big ideas that other brilliant people have already figured out. And finally, number 4, you got to use this stuff. You have to constantly practice applying your models to new problems and new situations.
And if you think that second step, scheduling time to think, sounds easy, get a load of this. A 2014 study found that a majority of men, 2/3, would literally prefer to give themselves a mild electric shock than spend just a few minutes alone with their own thoughts. I mean, that's just wild. It shows you how unnatural it can feel for us to just be quiet and think, but it also shows you how absolutely essential it is if you want to develop real wisdom.
Now, building wisdom isn't just about piling up knowledge. It's also about systematically learning from failure. And for Munger, this wasn't some fluffy, inspirational quote. It was a core, non-negotiable part of his process. He truly believed that studying mistakes, both your own and those of others, is one of the most powerful learning tools you have.
You just have to appreciate how blunt Charlie Munger was. There's no corporate speak here. He was a huge advocate for radical, brutal honesty about failure. The point isn't to make yourself feel bad. The point is to force yourself to analyze the errors so deeply, to feel it so acutely, that you will never repeat it. You rub your nose in it, so the lesson sticks for good. Munger breaks mistakes down into 2 big categories. First, you have mistakes of commission. These are the ones we tend to focus on. You actively did something you shouldn't have, like when Berkshire bought Dexter shoes right as its competitive advantage was evaporating.
But Munger argued, and this is so important, that the second type, mistakes of omission, the things you should have done but didn't, are often way, way more costly.
And what does costly even mean in this context? Let's put a hard number on it. Warren Buffett himself estimated that their single biggest mistake of omission, seeing how incredible Walmart was early on and then just failing to invest, cost Berkshire Hathaway at least $10 billion. $10 billion. That is the absolutely staggering price of doing nothing.
So after all this effort, building a latticework, turning yourself into a learning machine, and staring your mistakes in the face, what's the ultimate payoff? What's the end game? Well, it's about achieving a state of real, practical wisdom that helps you navigate the insane complexities of investing, business, and frankly, life itself.
And this right here is the crucial mind shift. The whole point of this system isn't to become a genius or to make some brilliant, once-in-a-lifetime prediction. The goal is actually much more humble, and because of that, it's much more powerful. It's simply to be consistently not stupid, to avoid the common, predictable, boneheaded errors that trip everybody else up. It's a game of avoiding mistakes, and worldly wisdom is your absolute best defense.
This final quote just sums up Munger's entire philosophy perfectly, doesn't it? We live in a world that is obsessed with complex spreadsheets and precise calculations, but Munger was always there to remind us that real wisdom, real insight, comes from something far more fundamental: deep, broad, multidisciplinary thinking.
And so that leaves all of us with a challenge. If the goal is to be consistently not stupid, then the work has to start right now. So my question for you is this: what is one big idea, one mental model from a field you know almost nothing about? Maybe it's biology or engineering or philosophy. What's one thing you can start learning this week to add a new, strong connection to your own lattice work?
Have you ever made a decision and then later, maybe a day, maybe a year later, you look back and just think, what on earth was I thinking? Of course you have. We all have. Well, the late great Charlie Munger, Warren Buffett's brilliant partner, he spent his entire life studying exactly that. The hidden psychological forces, the bugs in our mental software that cause us to make these completely irrational choices. So today, we're going to dive into Munger's wisdom and build ourselves a toolkit for thinking just a little bit better.
Okay, let's start right here, because this quote, this is everything. This is the foundation for our whole conversation. Munger's big idea is that our brains come preloaded with certain tendencies. They're like defaults or mental shortcuts. But, and this is the absolute key, just because you have a tendency doesn't mean it's your destiny. You're not doomed to follow it. Just by understanding these patterns, by knowing they exist, you suddenly have the power to spot them in the wild and say, nope, I'm going to choose a different path. So here's our game plan. First, we're going to look at the basics of our brain's faulty wiring. Then, we'll get into the incredible power of social influence and the sneaky ways we fool ourselves. After that, we build to Munger's most powerful concept, what happens when all these biases collide. And we'll wrap it all up by building a practical mental toolkit you can actually start using. All right, first things first. Before you can even think about fixing the problems, you have to understand the operating system you're working with. And it turns out, the software running in our heads is, let's just say it's a little outdated. Now, the technical name for these shortcuts is heuristics. And look, they're not all bad. Think about it. If you had to consciously analyze every single piece of information coming at you all day, you'd be totally paralyzed. You couldn't even decide what to have for breakfast. Heuristics are what let us get through the day, making quick, efficient judgments. They are absolutely essential. And this quote nails the core of the problem. Our mental software, these heuristics, they were designed for a totally different world. A world of immediate physical threats, scarce food, not a world of 24-hour news cycles and complex global financial markets. And that fundamental mismatch between our old software and our new world, that's where all the trouble starts. And this just lays it out perfectly. Back on the savannah, making a quick decision could save your life. Conserving mental energy was a massive advantage. But you take that same exact software and apply it to a modern problem like financial investing, well, you get what Munger called one boneheaded mistake after another. That ancient wiring that was designed to save us can now lead us right off a cliff. So let's move on to our first major category of these biases, and this one is huge. It's all about the incredible and often completely invisible power that other people have over our thinking. We are social creatures down to our very core, and that has profound consequences for how we make decisions. Munger identified a ton of these, but here are a few big ones. You've got social proof. That's when you walk past two restaurants, one is empty and one is packed, and you automatically think, well, the busy one must be better.
Then there's the authority misinfluence tendency, where we just blindly trust someone in a lab coat or with a fancy title. And of course, the liking/loving tendency, where we completely ignore the flaws of a person or a product just because we have a positive feeling about them. And this is Munger at his absolute best, telling a story to make a point. This isn't some abstract theory from a textbook. This is the real world. You have a bunch of highly paid, supposedly brilliant CEOs who saw one competitor make a move, and they just copied them. No independent thought. It was a herd of elephants running right off a cliff, and it cost them billions. That's social proof tendency in action. This single number on the screen, it represents one of the most chilling experiments Munger ever talked about. It's from flight simulators. They would have the pilot, the authority figure, make a clear, obvious, fatal mistake, one that would absolutely crash the plane. The co-pilot, who is a fully trained professional, knows it's a mistake. And yet, in a quarter of all cases, 25% of the time, the co-pilot just sat there and let the plane crash because they wouldn't question authority. That is the terrifying power of the authority misinfluence tendency. Okay, so we've seen how other people can lead us astray, but let's be honest, we're pretty good at messing things up all by ourselves. So now, let's turn inward and look at the ways our own minds systematically fool us. This is like a greatest hits album of our own internal mental traps. You've got simple psychological denial, where we just refuse to see a reality that's too painful to accept. Then there's our good old friend excessive self-regard, that deep down belief that, yeah, we're just a little bit smarter, a little bit better than average. Then there's our inner optimist, making us believe what we wish were true, not what the facts are telling us. And finally, our stubbornness, that powerful tendency to just cling to our old beliefs, even when the evidence against them is piling up. Munger's go-to example here was the mother of a truly obvious, hardcore criminal who remains completely convinced of her son's innocence. It's just a heartbreaking illustration of this tendency in action. The brain's first line of defense against painful information isn't to process it, it's to deny it exists. In business, finance, and in life, that denial can be absolutely ruinous. And this right here, this just perfectly illustrates the simple math problem with our own egos. Munger loved this fact. Way, way more than half of all Swedish drivers think they're above average. And look at investors. A staggering 91% of active investors think they're going to beat the market. But then look at that third bar, reality. Simple, cold, hard math says most of us can't be above average. It's mathematically impossible. That's our excessive self-regard tendency in a picture. So we've looked at social biases, and we've looked at our own internal biases. But now we get to the real heart of Munger's entire framework. This is the big one. What happens when these forces stop acting alone and they start working together? This is the million-dollar question. I mean, think about it. If one bias is like a gentle nudge in the wrong direction, what happens when you have 5 or 6 or 7 biases all shoving you in the exact same wrong direction, all at the same time? The result isn't just a bigger push, it's something else entirely. Munger had a great name for it, the Lollapalooza tendency. And the key phrase here is far more powerful than this sum of its parts. It's not additive. It's not 1 + 1 = 2. It's multiplicative. It's 1 + 1 = 10. It's like a psychological nuclear reaction where a few tendencies combine, they reach a critical mass, and they create these extreme, often wildly irrational outcomes. And this is the perfect example. Munger saw an open outcry auction as a Lollapalooza factor. Think about it. You've got social proof. Everybody else is bidding, so the item must be valuable. You have the deprival super reaction, that gut-wrenching feeling that you're about to lose it forever. It's going, gone. All of these forces combine at once to turn a perfectly rational person's brain into what Munger so elegantly calls mush. And it leads them to do something idiotic, like paying way, way too much. Okay, so this all might seem a little depressing. But the whole point of this isn't just to point out how flawed we are. The crucial question is, what do we do about all this? Knowing about these biases is the first step, sure, but it's not enough. Now we've got to talk about building a practical toolkit to actually fight back. I love this quote because it's so incredibly humbling. This is from Daniel Kahneman, a Nobel Prize winner who is probably the world's leading expert on these exact biases. And even he says, hey, knowing about them doesn't make me immune. So the goal isn't to become a perfect, bias-free robot. That's impossible. The real goal is to build a system of constant awareness and to have a few simple, powerful tools you can pull out when the stakes are really high. All right, here's our first tool for the toolkit. A huge source of terrible decisions is simply misaligned incentives. The antidote is what the writer Nassim Taleb calls skin in the game. And Munger gives us the perfect analogy to make it stick. The ancient Romans made the engineer who designed a new arch stand directly underneath it as they pulled the scaffolding away. Now that is an incentive to double-check your math. So whenever you're evaluating a proposal from someone, always ask yourself, do they have skin in the game? Are they standing under their own arch?
And here's our second tool, the courage to destroy your best-loved ideas. This was absolutely core to how Munger operated. Remember that inconsistency avoidance tendency? It makes us want to cling to our old ideas like a security blanket. Munger actively fought against that. He truly believed that if you go a whole year without fundamentally changing your mind on something important, you're not learning, you're stagnating. So we'll end with this. We've established you can't just erase these tendencies. They're baked into our DNA. They're part of being human. But you can become a better detective of your own mind. So think about a big decision you're facing right now, or maybe one you just made. After hearing about social proof and overconfidence and all these other mental traps, what's the one part of that decision you're going to look at again, with fresh eyes?
All right, let's get right into it. When you think about what makes an investor truly legendary, what's the first thing that pops into your head? For most of us, it's probably some kind of off-the-charts IQ, right? A math genius who can see the matrix. But what if I told you that for Charlie Munger, one of the greatest ever do it, that's not even in the top 5 most important things?
You know, this quote about Warren Buffett, it fits his longtime partner, Charlie Munger, perfectly. And it nails the big idea we're digging into today. The real magic, that right stuff, isn't about raw brain power. It's so much deeper than that. It's a genius of character. It's all about how you handle yourself, how you think, and most importantly, how you control those emotions that can wreck even the smartest people.
So here's how we're going to break this down. First, we'll talk about what this genius of character really means. Then, we're going to explore Munger's key attributes through 3 core pillars: mastering yourself, sharpening your mind, and playing for keeps. And stick around, because at the end, we'll reveal the one asset Munger believed was the most valuable of all.
All right, let's lay the groundwork here. Munger would be the first person to tell you that this stuff is hard, really hard. He admitted he struggled with these ideals his whole life, but he was convinced that just trying, constantly working on these traits was the only real way to get better results. Not just in your portfolio, but pretty much everywhere.
And that's a really crucial point. The goal here is not to be a perfect Munger clone. That's impossible. The real goal is progress, not perfection. It's about figuring out how to get 1% better, how to improve your thinking, learn a little more effectively, and, this is the big one, how to avoid those catastrophic mistakes, those unforced errors that can set you back years.
Okay, let's get into our first pillar, mastering yourself. This is all about winning the internal game. Honestly, if you don't get this part right, nothing else matters. This is the foundation. It's about your temperament, your emotional discipline, and having the right mindset before you even look at a single stock.
I love this slide because it perfectly captures the first critical trait, patience. Man, the world is constantly shouting at us, do something, make a move, don't get left behind. In the world of investing, that impulse is pure poison. Munger and Buffett understood a profound secret. Most of the time, the absolute best thing you can do is nothing. Just sit there and wait for the perfect opportunity.
And this quote is the natural result of that discipline. Buffett wasn't just being clever here. He was stating a fundamental law of the market. See, Munger didn't see investing as a game of prediction, of trying to guess what's going to happen next week. He saw it as a game of discovery, of patiently scanning the field until a true, undeniable bargain just shows up.
But patience has a flip side, decisiveness. Munger got this from his poker playing days. Think about it. In poker, you fold, and you fold, and you fold again. You're just waiting for a fantastic hand. But when you finally get pocket aces, you don't just limp in, you bet big. Investing is exactly the same. It's long, boring stretches of nothing, punctuated by these rare moments of intense, aggressive, decisive action.
And that brings us to the final exam of mastering yourself. Can you handle the pressure? This quote is everything. Look, market crashes are not an if, they're a when. They're part of the deal. If the very thought of watching your portfolio get chopped in half makes your stomach turn and your finger hover over the sell button, you are going to have a bad time.
That ability to stay calm, to have equanimity when everyone else is panicking, that is your ultimate superpower.
All right, so you've worked on your temperament. Now it's time to build the intellectual toolkit. This is Pillar 2, sharpening your mind. It's all about the mental habits you need for making good judgments. And it starts with something that a lot of really smart people, ironically, seem to lack: real, genuine humility.
Munger had this fantastic joke to illustrate the point. So picture this. Einstein dies and goes to heaven. An angel is showing him to his dorm room for orientation. The angel says, "Albert, this is your first roommate. She's got an IQ of 180.
Einstein's face lights up. He says, "Wonderful, we can discuss advanced mathematics." Then the angel introduces the second roommate, who has an IQ of 150. Einstein says, "Oh, fantastic, we can talk about theoretical physics."
Finally, the angel points to the third roommate who's got a perfectly normal IQ of 100, and Einstein breaks into this huge, beaming smile and says, "That's wonderful! So where do you think interest rates are headed?" The point Munger was making is just brilliant. A high IQ can actually be a disadvantage if it fools you into thinking you can predict something that is fundamentally unpredictable.
So if a high IQ isn't the answer, how do you actually get wise? Well, according to Munger, there was one non-negotiable path. And listen, he was absolutely hardcore about this. He said this all the time. For him, becoming a voracious, lifelong reader wasn't just a nice hobby. It was a flat-out requirement for anyone who wanted to have a clue about how the world works.
And that learning can't just come from books. You have to get your hands dirty. This is the scuttlebutt method. The idea is you have to be a detective. You don't just sit in your office reading reports. You get out there. You talk to a company's customers. You talk to their suppliers. And one of the best tricks, you ask the CEO of Company A what they think about Company B. That's how you get the real story, the ground truth. So to round out this pillar, you need a few more things in your toolkit. You have to be collegial. Munger said even Einstein needed people to bounce ideas off of. You need a trusted circle. And, this one's huge, you have to be non-ideological. A heavy ideology, whether it's political or economic, just acts like a set of blinders, stopping you from seeing reality as it actually is. Okay, on to our third and final pillar, playing for keeps. This is the big picture stuff. It's the strategic and, frankly, ethical framework you need not just to make money, but to hang on to it and compound it for a lifetime. This is about staying in the game. And it all begins with how you define risk. Now, forget what they teach you in Finance 101. Munger's definition is radically simple and practical. For him, there are only two real risks. Number one, the risk that you permanently lose your money. And number two, the risk that you get a lousy return on that money. That's it. That's the whole game.
Because of this, he thought the standard academic definition of risk, which is basically just stock price volatility, how much the price bounces around, was, and this is a direct quote, nuts. Think about it. A fantastic company's stock can be all over the place in the short term, while a dying business can have a very smooth, steady decline all the way to zero. Volatility isn't risk. For a prepared investor, it's opportunity.
Buffett tells this great story that really drives the point home. A jeweler friend of his brought $20 million worth of gems to a hotel to show them off. And he's showing Buffett the security setup, this massive safe, 2 armed guards were going to be there all night long. So Buffett is still looking a little nervous, thinking about everything that could go wrong. And the jeweler leans in close and whispers the secret. And besides, Warren, the jewels aren't in the safe. The whole philosophy is right there in that punchline. The absolute best way to manage risk is to avoid it in the first place. You don't try to outsmart it, you just refuse to play games you can't win. The last piece of playing for keeps is unwavering integrity. Munger was a huge Ben Franklin fan and he loved this idea. Honesty isn't just the best moral choice, it's the best business policy. It's practical. When people know they can trust you, deals get done faster, better opportunities come your way, and you build a reputation that compounds just like money in the bank. It is simply more profitable in the long run to be trustworthy. So we've covered a ton of ground, right? We've talked about temperament, about continuous learning, about long-term thinking. But what's the thread that ties all this together? What's the secret ingredient? What did Munger believe was the true engine that drives all of this success? We've built this entire framework. You've got Pillar 1, mastering your own psychology. Pillar 2, constantly sharpening your mind. And Pillar 3, operating with principles that ensure you stay in the game. It's a great model. But what powers it? What's the fuel for this engine? And here it is, passion.
Munger was convinced that a deep, almost obsessive passion for business and learning was more powerful than raw intellect. Passion is what makes you read that extra annual report when you're tired. It's the curiosity that drives you to make those scuttlebutt phone calls. It's what turns you into a lifelong learning machine. Without a genuine, burning passion for the game itself, you just won't do the work. It's that simple.
So, as we wrap up, I'll leave you with this question to think about. Seriously, take a minute and reflect on it. Looking at all these traits, the patience, the discipline, the rationality, the constant learning, the integrity, which one of these comes most naturally to you? And which one is your biggest struggle? Because as Charlie Munger showed us, the real genius of investing isn't about being the smartest person in the room. It's about that lifelong, passionate commitment to becoming a little bit wiser every single day. And that whole journey starts with knowing yourself. All right, let's dive in. Today, we're going to try to unlock the thinking behind one of the greatest investors, and frankly, one of the greatest thinkers of all time, Charlie Munger. We're going to break down his core philosophy, not just as a list of rules, but as a complete system for making better decisions, whether you're investing or just navigating life. So to kick things off, let's explore the one idea that really shaped his entire worldview.
You hear this quote all the time, right? And it's not about being morbid or anything like that. It's about this powerful idea he called inversion. It's about the incredible power of just avoiding mistakes. Munger truly believed that if you can simply avoid the common pitfalls, the standard stupidities that everyone else falls into, you're already way ahead of the game. This concept of avoiding failure, it's the absolute bedrock of his entire playbook.
So that's really the big question we're tackling here, isn't it? How did this relentless focus on not being dumb, instead of trying to be a genius, lead to such unbelievable success? Well, the secret isn't some complex secret formula. It's a repeatable system for clear thinking, and it's designed specifically to sidestep the emotional and psychological traps that trip up even the smartest people out there.
So here's how we're going to break this all down. First, we'll dig into the foundational mindset. These are the 3 essential mental checks he always performed. Then we'll see how that mindset translates into a real-world investor's action plan. After that, we'll explore the Munger evolution, which is his biggest contribution to the world of investing. And finally, we'll wrap it all up by showing you how to adopt this Munger mindset for yourself.
All right, let's jump right into those foundational pillars. Before Charlie Munger even thought about an investment, he ran it through 3 crucial mental filters. And these aren't just steps on a checklist. They're a completely different way of seeing the world.
Okay, so pillar number 1 is something you've probably heard of, intrinsic value. Now let's be super clear. This has nothing to do with the stock price you see flashing on your screen. It's an estimate of what a business is truly worth if you owned the whole thing, all the cash you could take out of it for the rest of its life. You can think of it as the anchor of reality in a sea of wild market speculation. But here's the catch, and it's a critical one. Munger's partner, Warren Buffett, puts it perfectly here. Intrinsic value is not a precise number. It's an estimate, it's a range, it's fuzzy. Even 2 geniuses like Munger and Buffett, looking at the exact same business, would come up with slightly different numbers. And just admitting that fuzziness exists is the first big step toward the kind of intellectual honesty that Munger valued so highly. And that idea right there, that fuzziness, it leads to what might be Munger's most powerful and honestly simplest tool, the too hard pile. You know, a lot of really smart people, they love a complex puzzle. But Munger knew that complex valuations are exactly where our psychological biases sneak in and cause huge errors. So if the value of a business wasn't simple enough to be almost screamingly obvious, he just passed. He put it in the too hard pile and moved on. He knew he didn't have to swing at every pitch. Okay, pillar number 2, the margin of safety. This is your lifeline. If you accept that intrinsic value is a fuzzy estimate, then the margin of safety is your protection against that fuzziness. It's the cushion you create by buying something for way less than your conservative estimate of what it's worth. This is what saves you from bad luck, bad timing, and from your own inevitable mistakes.
Now this is where Munger's thinking really flips the script for a lot of people. Most of us think, hey, if I buy a great company, it's a safe investment. Munger would say that's a really dangerous way to think. For him, safety has nothing to do with the quality of the company. Safety comes from the price you pay. A fantastic business that you buy at an insane price is a pure gamble. But a so-so business that you buy for pennies on the dollar, that can be an incredibly safe investment. The price you pay is everything. And that brings us to the 3rd and final foundational pillar, the famous circle of competence.
This is all about being brutally honest with yourself about what you know, and maybe even more importantly, what you don't know. Munger's rule here was pretty simple. If you can't clearly define the edges of your expertise, then you don't really have any expertise. For him, knowing the perimeter of your circle was way more important than how big the circle was.
You know, this quote just says it all, doesn't it? It shows his incredible humility. Munger's real genius wasn't just in his competence, but in his deep, deep understanding of his own incompetence. By strictly staying away from areas where he knew he was at a disadvantage, like high tech for a huge part of his career, he made sure he was always playing a game he knew he could win.
Okay, so we've got the mindset down, the 3 pillars. But how does that actually turn into an action plan? You know, what do you do with it? This next part is all about how to structure a portfolio, when you should act, and just how much you should bet when you do.
Well, first off, Munger absolutely hated what he called diversification. It's a great term, right? He was talking about the tendency to diversify so much that your returns are guaranteed to be mediocre. And this chart shows the difference perfectly. Most funds, these closet indexers, they hold hundreds of stocks. Munger, on the other hand, was all about focus investing. Why? Well, because it's much better to know a ton about a few great companies you really get than to know just a little bit about 100 of them. It forces you to be disciplined and ensures you only put your money into your absolute best ideas.
So, you've got your handful of great companies. When do you sell? Munger's answer? Almost never. Seriously. His whole philosophy was to buy a wonderful business and then just hold it, pretty much forever. And the advantages are huge. You pay way less in taxes, way less to brokers, and you listen to way less useless noise from the market. For Munger, doing nothing, inactivity, was a massive strategic advantage.
And this brings us to maybe the most crucial part. When you do act, how much do you bet? Munger saw the stock market like the betting system at a horse track, the pari mutuel system. It's not about picking the horse that's gonna win. It's about finding the horse where the odds are massively in your favor. The best horse isn't the best bet if everyone is betting on it. But when you find that rare, obvious, mispriced opportunity, you don't just nibble, you bet big.
All right, this next section, this is arguably Munger's single greatest legacy. It's where he took the core ideas of his mentor, the legendary Ben Graham, and he evolved them into something new. This is the change that fundamentally altered the course of value investing and, of course, the history of Berkshire Hathaway.
And this slide just nails the difference. Ben Graham, the father of value investing, his whole thing was what he called the cigar butt approach. He'd look for these beaten-down companies that had one last free puff left in them. You could buy a fair business at a wonderful rock-bottom price. But Munger convinced Buffett that it was much, much better to buy a truly wonderful business at a merely fair price.
So what exactly is a wonderful business? Well, it all comes down to one thing: a durable competitive advantage, or what they famously call a moat. This is some special characteristic. It could be a powerful brand, a network effect, a low-cost advantage that protects the business from competitors, just like a moat protects a castle. That moat is the source of the company's long-term value.
And Munger's quote here really drives home why that moat is everything. A business with a wide moat, as he explains, is just easier. It gushes cash, and management gets to make simple, pleasant choices. But a business without a moat, it's a constant, brutal struggle, with one painful, agonizing decision after another. Over the long run, that difference is absolutely everything.
Okay, so let's pull all these threads together. We've talked about the mindset, the action plan, the evolution. How does this all become a playbook that we can actually use? How do we synthesize this into something actionable? When you really boil it down, it comes down to these 5 simple, powerful steps. Step 1, define your circle of competence and do not leave it. Step 2, always insist on a margin of safety. That cushion is non-negotiable. Step 3, be patient. Wait for that rare, obvious opportunity, the fat pitch right down the middle of the plate. Step 4, when that pitch comes, swing for the fences. Bet big. And finally, step 5, always favor those wonderful businesses with wide moats, because at the end of the day, quality is what wins in the long run. And that really leaves us with the final big question. You see, Munger's system, it's brilliantly simple, but it is not easy. Not at all. It goes against every human instinct we have to constantly do something. The secret ingredient isn't how smart you are. It's your temperament. So the real question you have to ask yourself is this: do you have the discipline, the patience to just sit there and do nothing most of the time?
All right, today we're going to crack open the playbook of a true legend, Charlie Munger. We're going to tap into his incredible wisdom to answer a really big question. What actually makes a business a great business?
You know, before we really get into the weeds, you have to understand that Munger's entire philosophy, it really all hangs on one simple but powerful shift in how you see things. And it all starts with this one question. When you buy a stock, what is it that you're really buying? And there it is, right from the man himself. Munger learned this from his mentor, Ben Graham, and he was just relentless on this point. You're not buying a ticker symbol. You're not just playing a video game on a screen. You are buying a piece, a small slice of a real living, breathing company. And once you truly get that, it changes the entire game. Okay, so here's our roadmap for today. First up, we're going to go beyond the ticker symbol. Then we'll get into the real levers of control with capital, pay, and power. After that, we'll dive into the big one, the indispensable moat. Then we'll cover the people side of things with integrity over brilliance. And we'll wrap it all up with the Munger test, so you can put these ideas to work.
So let's jump right into section 1, beyond the ticker symbol. If you're really thinking like an owner, you have to ask yourself a pretty basic question. What is the actual job of the people running this company? What should they be spending their time on? This is fascinating, right? On the one hand, you've got what most people assume leaders do. Manage the day-to-day, get into all the details. But then you've got the Munger and Buffett way of doing things at Berkshire. They pretty much delegate everything except for 2 jobs. 1, finding and keeping the best managers. And 2, and this is the big one, deciding where the money goes. That's it. They figured those 2 things were the ultimate drivers of long-term value. Everything else, let the great managers handle it. And that's the perfect setup for section 2, capital, pay, and power. We're going to go a little deeper now on those 2 core functions, how a company uses its cash and how it pays its people. Because for Charlie Munger, these weren't just boring administrative tasks. No, these were the absolute levers of control, the clearest signs you could find of a business that's built to last. And Munger couldn't have been more direct about this. For him, deciding where to put the company's money, that was job number 1, period. Think about it. A really good business throws off a ton of cash. The biggest, most important decision isn't just how to make more widgets next quarter, but what do you do with all that profit? Where do you reinvest it to get the absolute best return for the owners? That right there is the billion-dollar question. But here's the problem. There's this huge, invisible force that's always working against smart decisions. Warren Buffett gave it a name, the institutional imperative. It's kind of like a corporate gravity. This pull that makes big organizations just mindlessly copy what everyone else is doing and fight against any kind of change, even when it's clearly a bad idea for the people who own the company. And here's how you can spot this thing in the wild. Buffett called these the 4 horsemen. First, the company just resists any change to what it's already doing. Second, projects just kind of appear out of nowhere to use up whatever money is lying around. Third, and this one is classic, a silly idea from the boss suddenly gets backed up by all these official-looking studies. And last but not least, the company just mindlessly copies whatever its competitors are up to. A great business has to fight these things every single day. Okay, so that's capital. The second lever of control is pay. And oh man, when it came to how executives get paid, Charlie Munger, he did not hold back. He saw most compensation consultants as just creating these ridiculously complicated, unfair pay packages that didn't help the owners of the business one bit. So what was the Munger way? It was all about radical simplicity. At Berkshire, there's no giant 200-page manual on compensation. Nope. Each business has its own simple, unique pay system that's designed to make sure the managers think like owners. And get this, they almost never change them. The story goes that the pay deal for the manager of See's Candies was written on a single piece of paper decades ago, and they never touched it again. It's about figuring out what works and just sticking to it. All right, on to section 3. We've talked about the people running the show. Now let's talk about the business itself. And this brings us to probably the single most famous idea from Munger and Buffett, the indispensable moat, that big, beautiful fortress of competitive advantage. This quote from Buffett just nails it. It perfectly shows you what they thought was most important. Look, you could have the greatest jockey in the world, but if the horse is a broken-down nag, you're not going to win the race. And that's why Munger would always bet on a great business over a great manager. Because a truly great business, a good horse, can protect your investment even if the person running it for a little while is just okay. So if the moat is that important, what is the job of the people in charge? Well, Munger was super clear about this.
He said their only real duty is to widen the moat. Every single decision they make should be measured against that one simple test. Does this make our competitive advantage bigger and stronger? He really saw it as a kind of stewardship. And it's so simple when you break it down like this. Step 1, you're handed the keys to a castle that has a moat around it. Step 2, every single day, your job is to get a shovel and dig that moat a little wider and a little deeper. And step 3, when you're done, you have to hand that castle over to the next person with a bigger, badder moat than the one you started with. Simple as that. All right, so we've established that the business itself, the moat, is king. That leads us right into section 4, integrity over brilliance. Because once you start looking at the actual people running the business, Munger had a very, very clear idea of what mattered most. And let me give you a hint, it wasn't a genius-level IQ. And, only Charlie Munger could say it like this. This quote is blunt, but it says everything. For him, integrity was a yes or no question. It was non-negotiable. You can't have a company that's just mostly honest. He believed that even a little bit of dishonesty contaminates the whole thing. It was a zero-tolerance issue.
This idea brings us right back to the moat as the ultimate protection. Munger's famous line was that you want a business so good that even a fool can run it, because sooner or later, one will. And that just perfectly explains why the moat is so important. CEOs retire, people make bad decisions, every company eventually hits a rough patch with its leadership. A truly great business is strong enough to survive it. But Munger wasn't so rigid that he couldn't see exceptions. He knew there was one time you could break the bet on the business, not the manager rule. And that was when you found a true once-in-a-generation genius. People like Sam Walton at Walmart or Ajit Jain running reinsurance at Berkshire. These are the rare folks who are so good, they are the competitive advantage. They can build a moat where one didn't exist before.
Okay, let's bring it all home. Our final section, the Munger test. We're going to take all of these incredible ideas and boil them down into a simple, practical framework, something you can actually use to see any business through Charlie Munger's eyes.
So here it is, the whole thing on one slide. This is how you think like Munger. Number 1, you've got to assess how good management is at allocating capital. That's their most important job. 2, check to make sure the way they get paid actually aligns them with you, the owner. 3, analyze that moat. How wide is it and how long is it going to last? 4, demand absolute, unquestionable integrity from the top. And 5, the big rule. Bet on the business, not the jockey. Unless, of course, you're lucky enough to have found yourself a true genius.
In the end, this is so much more than just a stock-picking checklist. It's really a framework for rational thinking, for making better decisions about almost anything. And it leaves all of us with one simple, incredibly powerful question to ask before we make our next big move. What would Charlie Munger do?
When you think about Wall Street, you think of unbelievably complex math, right? Supercomputers, PhDs. But what if I told you that the greatest investment firm in history, Berkshire Hathaway, built its entire empire using math you could literally scribble on the back of a napkin? Well, today we're going to pull back the curtain on the shockingly simple formula that Charlie Munger and Warren Buffett used to generate decades of incredible returns.
So let's just start with this big question. All those crazy financial models, the jargon, the algorithms, what if it's all just a distraction? What if the real secret to becoming a phenomenal investor isn't about being a math genius, but just about applying some good old-fashioned common sense? That's the idea we're going to really dive into today.
Okay, this is where things get a little weird, and frankly, a bit rebellious. When Buffett and Munger are trying to figure out what a business is worth, they start with the absolute safest interest rate you can find anywhere on Earth, the rate on a U.S. Treasury bond. Now, if you told that to a finance professor, they'd probably have a heart attack. It sounds insane, because it seems like you're completely ignoring the risks of the actual business. So, why in the world would they do this?
Well, the answer, and this is the first huge key to unlocking their entire philosophy, isn't about ignoring risk at all. It's about looking at the entire problem through a totally different lens. And that lens is something called opportunity cost.
Think about it like this. Every single time you say yes to one thing, you are, by definition, saying no to everything else you could have done with that same time or money. The opportunity cost is just the value of the best no you just gave up. It forces you to constantly ask this really powerful question: is this truly the best possible thing I can do with my resources right now? And this slide just lays it out so clearly. Conventional wisdom says you have to cook up some unique, super complicated formula for every single business to figure out its cost of capital. The Berkshire way? It's radically simpler.
They just say, look, at any given moment, we can buy a government bond and get a certain return with basically zero risk. That's our baseline. So everything else, doesn't matter if it's a railroad or a soft drink company, has to be measured against that one simple yardstick.
And here's the man himself, Charlie Munger, just driving it home. This isn't some clever little trick they use for stocks. He says this is how they make all their decisions. It's the bedrock of their thinking. It's not about finding something that's good. It's about finding the absolute best alternative available.
Okay, so you might be thinking, all right, I get the yardstick thing, but what about risk? If they're not putting it in the formula, where does it go? And that brings us to the second huge insight. They don't try to price risk, they try to avoid it completely. Here's what that means.
You see, their entire definition of risk is completely different from what they teach you in business school. For most of academia, risk is volatility. You know, how much a stock price bounces up and down. Munger thought that was just plain absurd. For him, risk was simple. It was real. It's the chance that you will permanently lose your money. Full stop. It's not some number on a spreadsheet to be managed. It's a real-world disaster to be avoided at all costs.
So what do they do when they come across a business that seems too complicated or where the future is just too foggy to predict? They don't build a fancier spreadsheet. They don't hire a consultant. They do something brilliantly simple. They throw it in what they call the too hard pile, and they just move on to the next idea. It's an incredible act of intellectual humility.
So this is their filter in action. They're basically hunting for businesses that are so incredibly stable, so predictable, that there's practically no risk to begin with. We're talking about companies like Coca-Cola or See's Candies. They're not trying to be fortune tellers. They're looking for businesses with a present that's so strong and durable, it's almost guaranteed to just keep on chugging into the future.
All right. But even with all of that filtering, they know they're not gods. They're human. They know they can make mistakes. And that brings us to the final and probably the most famous piece of their entire mental framework, the margin of safety.
I mean, this is the big question, right? If the business is supposed to be safe and the yardstick is the risk-free rate, what's the safety net? What happens if their own analysis, their own judgment is just wrong?
The answer is this number right here, 25%. As a hard and fast rule, they will not buy an asset unless they can get it for at least 25% less than their own conservative calculation of what it's truly worth. This isn't a suggestion, it's a non-negotiable law for them.
And here is the absolute key distinction. That discount, that margin of safety, it is not there to protect them from the business being risky. Remember, they already filtered all that out with the too hard pile. No, this cushion is there to protect them from themselves. It's an insurance policy against their own human error, their own miscalculations, or just plain bad luck. It's humility built right into the math.
So let's put this all together. Let's say a company has made it through all their filters. It's simple, it's predictable, they understand it, and it's selling at a nice discount. What does the actual math look like? Well, you might be surprised by just how simple it really is.
This is it, the whole shebang. It's a simple three-step dance. First, they figure out the real, honest-to-goodness cash that the business generates, what they like to call owner's earnings. Second, they plug in a very, very conservative guess for how much those earnings might grow. And third, they just run that simple discounting math using the boring old treasury rate as their yardstick. That's it. No crazy algorithms, no financial gymnastics.
Oh, and here's a quick but super important detail. They focus intensely on a number called return on equity. It basically tells you how good a company is at turning its own money into more money. They care about that way, way more than the earnings per share number that Wall Street and the financial news are always screaming about.
And this quote from Munger, I mean, it just says it all, doesn't it? He absolutely hated financial jargon like EBITDA. That's earnings before interest, taxes, depreciation, and amortization. He saw it as a way companies often try to hide their problems. He just wanted to see the cold, hard cash. He wanted companies that were, as he said, drowning in cash.
So as we wrap this up, you start to see what's really going on here. The secret isn't a formula you can just punch into a calculator. The math is the easy part. The secret, the thing that's so hard to copy, is the mindset that makes the math work in the first place.
This, right here, this is the real secret formula. It's the discipline to sit on your hands, sometimes for years, just waiting for that perfect pitch. It's the simplicity to stay inside your circle of competence and not chase things you don't understand. It's the rationality to always, always measure one choice against your next best alternative. And maybe most of all, It's the humility to know you're not a genius, that you could be wrong, and to build a massive cushion for your own mistakes.
And I'll leave you with this final thought, because this way of thinking, it applies to so much more than just stocks. Think about your own life, your career, big relationships, major decisions. Where are we all making things way more complicated than they need to be? Where are we trying to solve for every possible outcome instead of just avoiding the obvious stupid risks? What could you simplify in your life by just having the courage to admit that something is too hard, and instead focusing all your energy on the simple, durable opportunities that are right there in front of you?
You ever wonder why some companies seem almost invincible, lasting for generations, while so many others just flicker out and disappear? Well, according to the legendary investor Charlie Munger, the answer isn't about luck. It's not magic. It's about defense. A powerful, durable advantage he famously called an economic moat. Today, we are opening up Munger's playbook to understand exactly how the world's greatest businesses protect their castles and manage to endure.
All right, so here's how we're going to break this down. First, we'll set the scene on what Munger called capitalism's brutal battlefield. It's essential to understand why you even need protection. Then, we'll define the economic moat itself before getting into its primary sources. We'll start with the raw power of scale, then move to the more subtle strength of things like brands and patents. We'll see how it all comes together in the ultimate case study, Berkshire Hathaway, and then wrap up with Munger's most important warning. Even the widest moats can run dry.
So, before we can really appreciate the solution, we have to respect the problem. And for Charlie Munger, the world of business was never some cozy club. No, it was a relentless Darwinian fight for survival.
Munger never minced words, did he? He just knew that the default state of any business is to be under siege. You've got competitors constantly, relentlessly trying to copy what you do, steal your customers, and chip away at your profits. This unforgiving landscape is the starting point for his entire philosophy. Because without a real structural defense, failure isn't just a risk, it's pretty much an eventual certainty.
I mean, this is the fundamental question, isn't it? And the answer isn't just about having a great product for a year or two. The secret to real, lasting success, the kind of compounds over decades, is all about building a structural advantage. It's about having a defense that is so formidable, it makes competitors think twice before even trying to attack.
And that leads us right to the cornerstone of the whole Munger and Buffett investment philosophy, the economic moat. This is their answer to the brutal challenge of capitalism.
The metaphor is just brilliant because it's so easy to picture. Imagine your business is this magnificent castle, right? And the profits it generates are the treasure locked away inside. Well, your competitors are the invading armies, always sizing up your walls, looking for a weak spot, a way in. An economic moat is that deep, wide body of water all around the castle that makes any assault costly, difficult, and a lot of the time completely pointless. It's what protects the treasure for the long haul.
So what exactly fills these moats? Well, Munger pointed to 5 main sources. We're going to start with 2 that are all about sheer size, supply side and demand side economies of scale. Then we'll look at 3 really powerful intangible advantages: the psychological power of a brand, the protective shield of government regulation, and the legal monopoly you get from patents. Let's break down how each one of these works.
First up is scale, and this is a big one. In business, sometimes just being the biggest player in the game creates an advantage that is almost impossible for a smaller rival to overcome. And this power shows up in 2 fundamentally different ways.
Okay, so there are 2 flavors of this scale advantage, and they're really different. First, you have supply-side scale. This is your classic cost advantage. Think of Walmart. Because they operate at this colossal scale, their cost to stock and sell, say, a can of soup is way lower than the little corner stores. They can offer a lower price and still make a profit, which just squeezes out smaller competitors. But demand-side scale, what a lot of people call a network effect, that's a whole different kind of magic. Take American Express. Every new person who gets a card makes the network more valuable to stores, and every new store that accepts the card makes it more valuable to us, the cardholders. It becomes this self-reinforcing loop where growth itself is the moat.
And here's a fantastic example of just how powerful that supply-side advantage can be. Munger often talked about the early days of television. You only had 3 networks, right? And advertising was incredibly effective but also brutally expensive. So a giant like Procter & Gamble could just blanket the country with ads for Tide detergent because their huge sales volume made the cost worth it. But a smaller detergent maker, they were completely locked out. So the big got bigger, not just because their product was better, but because their scale gave them exclusive access to the most powerful customer-getting tool on the planet.
Now, moving beyond sheer size, some of the most powerful moats are completely intangible. You can't see them, you can't touch them, but they can be even tougher for a competitor to get over than a simple cost advantage.
This classic quote from Buffett, man, it just gets right to the heart of what a brand moat is. When he and Munger bought See's Candies, they learned pretty quickly it wasn't just about how the chocolate tasted. It was about decades of accumulated trust and positive emotion. You know, the box of See's at birthdays, anniversaries, holidays. That feeling is literally baked into the customer's mind. And that creates this powerful emotional connection that lets See's charge a premium price. A new competitor just can't replicate that trust and history overnight, no matter how good their chocolate is.
And this brings us to the ultimate test of a brand's strength, right? You have to ask, could a competitor with a blank check replicate it? Buffett's famous thought experiment about Coca-Cola is the perfect example. He basically argued that even with tens of billions of dollars, you could not erase a century of memories. Memories of refreshment, happiness, consistency that are all tied to that red and white logo in billions of minds all over the globe. That's not just a moat. That is a fortress.
All right, the last two intangible moats on our list are a little different. They're protections that are basically granted to you by an outside force, the government. Regulation can create a really powerful barrier. For a company to issue corporate bonds, for example, regulators require a rating from a tiny handful of trusted firms, like Moody's. This creates a legally protected little club. And then you have patents, which give a company a temporary government-granted monopoly on an invention. When Berkshire invested in a company called Lubrizol, they were really buying its portfolio of over 1,600 patents. That formed a legal wall protecting its chemical formulas from any competition.
So, we've seen the individual bricks, right? Scale, brand, patents. But what happens when a master architect combines them all? For that, we turn to the absolute pinnacle of this philosophy, Munger and Buffett's masterpiece, Berkshire Hathaway.
Okay, and this is where it gets really mind-bending. The genius of Berkshire Hathaway isn't just that it owns a bunch of companies with moats. The real genius is that the structure of Berkshire itself has become this massive, systemic moat. It's like a web of interlocking advantages that all feed off each other, creating a corporate fortress that is stronger than any of its individual businesses could ever be on their own.
Let's walk the ramparts of this fortress for a second. First, it's incredibly tax efficient. They can move money from a business that's gushing cash to a new opportunity without taking a big tax hit. 2, they have this culture of extreme trust and decentralization, which means almost no corporate overhead. 3, their sterling reputation makes them the buyer of first resort for family businesses looking to sell. 4, their capital is permanent, which means they're never forced to sell something at a bad time. And 5, the engine at the very heart of the castle, the insurance float.
I mean, the scale of this is just staggering. Float is basically the cash an insurance company collects in premiums that it gets to hold on to and invest before it has to pay out any claims. It's essentially a massive interest-free loan from all its policyholders. And just look at that growth. Munger and Buffett have brilliantly used this ever-growing mountain of low-cost capital to buy more businesses with more moats, which in turn generate more cash to buy, you guessed it, more businesses. It's this powerful, self-fueling, virtuous cycle that is nearly impossible for anyone else to replicate.
Now, after building up this whole vision of these impenetrable fortresses, we come to what Munger considered the most important lesson of all. It's a dose of hard-nosed realism. No moat is permanent. No fortress is forever. The world changes, and defenses that once seemed invincible, well, they can crumble.
Kodak is the textbook case. For decades, it had a fortress built on brand, on proprietary technology, a massive distribution network. It was the very definition of a wide moat business. But a single technological shift, digital photography, made all of those advantages totally irrelevant. The moat didn't just shrink, it evaporated. And for Munger, this wasn't some tragedy. It was simply the brutal, unsentimental process of capitalism at work, a powerful callback to where we started.
Or think about the local newspaper. For 100 years, it was the only game in town. It was a geographic monopoly on local news, on classifieds, on advertising, an absolute cash machine. Then the internet arrived, followed by Craigslist and Facebook Marketplace. Technology didn't just attack the newspaper's moat, it blew it to pieces, leaving their economics, as Munger would say, grievously impaired. And this process of decay, it can be slow and then all of a sudden terrifyingly fast. I mean, decades ago, the big department store downtown was a fortress. Its location and its scale were its moat. Then, the rise of the automobile and the suburbs, that started to chip away at it. And today, the relentless assault of e-commerce has drained that moat completely for so many of them, showing how forces that build up over years can lead to a sudden collapse. So this is the ultimate tool that Munger gives us. It's a mental model for thinking clearly about any business. When you see a really successful company, don't just admire it. Interrogate its success. First, you have to identify why it's happening. What is the precise nature of its moat? And then you have to relentlessly play devil's advocate and ask that critical question: what forces out there in the world could cause this to stop? What technological shift, what change in consumer habits could drain the water from this moat and let the invaders in?
And that leaves us with a final challenge. Apply this framework to the world you see around you. Think about the phone in your pocket, the bank you use, the software on your computer, the grocery store down the street. Which of them have a truly durable competitive advantage? And here's the billion-dollar question. Is that advantage getting wider and deeper with each passing year, or are you maybe seeing the first signs that the water level is starting to fall? The answer to that question tells you everything you need to know about their future.
You know, in the entire world of investing, there is one single word that causes an unbelievable amount of confusion. And that word is value. You see it on a fund, you see it in an article, and you think, okay, I know what that means. But what if I told you that word actually represents two completely different, almost opposite ways of thinking about money? Well, today we're going to untangle that mess once and for all.
So let me ask you this. When you see a value fund, what's the first thing that pops into your head? For most of us, it's the legends, right? It's Warren Buffett. You assume you're buying into that same brilliant system of deep business analysis. But are you? Well, the answer, and this might surprise you, is almost always no. And knowing why is absolutely critical.
You see, all this confusion comes from two totally distinct camps that both lay claim to the word value. In one corner, you've got the academics, think Eugene Fama and Ken French, with their factor investing model, and in the other corner, you have the practitioners, the legends like Ben Graham and all his disciples, who practice what we'll call true value investing. They're using the same word, but believe me, they are living in completely different universes.
All right, so here's the game plan. First, we'll look at these two faces of value. Then we're going to dive deep into the academic factor view, and then we'll contrast that with the practitioner's value approach. I've got a super simple basketball analogy that's going to make it all click. And then we'll wrap it up by talking about why this distinction really matters for your own money.
Okay, first up, the two faces of value. And listen, this is not just a minor disagreement over details. We're talking about one word being used to describe two totally separate universes, built on ideas about how the market works that are polar opposites.
The most important thing to get your head around is that these two methods aren't even trying to solve the same problem. They're not even in the same ballpark. The academics, Fama and French, they're trying to explain a giant market-wide puzzle. Why do certain groups of stocks seem to outperform over time? Ben Graham, on the other hand, he's asking a much more practical question. How can I find one specific company that's a fantastic bargain with very low risk? See the difference? One is a scientist, the other is a treasure hunter. So let's dig into that first philosophy, factor investing. This is the top-down, academic, by-the-numbers approach. And it's the engine behind the vast majority of funds you'll see out there with value in their name.
Now, factor investing is built on one huge foundational assumption: that markets are efficient. What does that mean? It means all information is already baked into the price, so you can't really beat the market through smarts. Any extra return you get must be because you're taking on more risk. So when these academics see a whole group of stocks doing better than average, they don't think, oh, those must be cheap. No, they think, there must be some hidden risk here that the market is paying us for.
And you can follow their logic step by step. First, you assume the market is perfectly efficient. But when you look at the data, you see these weird anomalies where certain stocks consistently win. So, to make your theory work, you have to invent something to explain it, an undiscovered risk factor. After crunching mountains of data, they landed on the book-to-market ratio, and they slapped a label on it, the value factor.
So, what does this look like in practice? It is a purely mechanical, hands-off process. Finding value is as simple as running a search on a giant database. You're just looking for companies with a high ratio of book value to market price. That's it. You don't care what the company does, who runs it, or what its future looks like. It is a numbers game, plain and simple.
Okay, now, let's just hit the brakes and pivot to a completely different universe. Value investing, the way Ben Graham and his followers practice it. This is the get your hands dirty, bottom-up approach that is the total opposite of a simple database screen.
Graham's philosophy starts from the complete opposite idea, that markets are inefficient. He famously imagined the market as your moody, manic-depressive business partner, Mr. Market, who one day offers to sell you his shares for a ridiculously low price and the next day wants to buy yours for a crazy high one. The goal, then, is to do the hard work, to figure out what a business is actually worth, its intrinsic value, and then you just wait patiently for Mr. Market to have a bad day and sell it to you at a huge discount.
And the potential payoff for all that hard work? It's massive. Just look at this example. Say you find a great business, and you conservatively estimate it's going to spit out $100 million in cash year after year. And right now, Mr. Market is so depressed, he's willing to sell you the entire company for just $500 million. Well, that's a 20% annual return on your money. That's not a tiny statistical edge. That is a home run investment.
You see, this isn't some simple formula. It's a deep philosophy. It forces you to think like a business owner, not just a stock ticker watcher. You have to demand what Graham called a margin of safety, that huge gap between the price you pay and the value you get. You have to learn to use the market's crazy mood swings to your advantage. And maybe the hardest part of all, you have to stay rational when everyone around you is panicking. The factor approach involves none of this deep, psychological heavy lifting.
Okay, I get it. This can all feel a little bit abstract. So to make this crystal clear, let's use a really simple analogy. Imagine we're building a basketball team.
So we have two strategies. Team A goes with the factor investing approach. They find a statistical pattern. On average, tall people are better at basketball. So what do? They just go out and recruit the 100 tallest guys in the city. No tryouts, no interviews, no checking if they can even dribble, just a simple screen for height. Team B, on the other hand, uses the Graham value investing approach. They hold open tryouts. They spend weeks watching guys, meticulously evaluating every single skill, shooting, defense, teamwork, and then they pick the 15 best players for their team.
So, how do the teams do? Well, Team A, the team of just tall guys, they'll almost certainly be better than an average team. The statistical correlation does work. But Team B, the team that was picked after deep individual analysis, Team B is going to absolutely wipe the floor with Team A. Why? Because they didn't just use a proxy for skill, like height, they went out and measured skill directly.
So let's just put it all together here, side by side. Factor investing starts with efficient markets, uses a top-down computer screen, and its goal is a small statistical edge. Value investing starts with inefficient markets, uses bottom-up, individual business analysis, and is aiming for significant long-term home runs. They are fundamentally different beasts.
All right, last section. Let's bring this all home. Why on earth does any of this academic stuff matter to you? Well, because this is where the theory smacks right into your real-world portfolio.
When you boil it all down, it's about ambition. The goal of factor investing is really just a little tweak on passive index investing. You're trying to tilt your portfolio a little bit to hopefully scrape out an extra 1 or 2% premium over time. The goal of Graham-style value investing is something else entirely. It's about doing the hard work to find those rare opportunities that could potentially crush the market over the long haul.
And as the saying goes, the proof is in the doing. You just have to look at the results. Think about Warren Buffett's famous essay, The Super Investors of Graham and Doddsville. He lays out the incredible, real-world track records of investors who followed Graham's principles, not a statistical model, but the hard work of business analysis. And the results? Well, they speak for themselves.
So this brings up the obvious question, right? If these two methods are polar opposites, why in the world does the financial industry seem totally happy to let everyone stay confused? Well, as you can probably guess, there's a very powerful incentive for them to do just that. It all comes down to marketing. It's called the halo effect. See, it is way easier and cheaper to run a computer program than it is to hire a team of brilliant analysts to do real, intensive business research. So by calling their simple factor fund a value fund, these firms get to borrow the incredible halo of success from legends like Warren Buffett. They get to attract your money because you think you're buying Buffett's brain, when what you're really getting is a simple database script.
And that right there is the heart of the whole problem we set out to fix today. So many smart people just assume that what Buffett and the other legends do is just a more sophisticated version of the academic factor model. But as we've seen, that's just not true. They're not even playing the same game. They're not even in the same stadium.
So I'll leave you with this final thought. Now you know. You know there are two completely different worlds hiding behind that one little word value. So the next time you see a fund being sold to you that way, you can ask the critical question.
What are they really selling me here? Are they selling me a simple statistical screen, or are they selling me a deep philosophy of business analysis? Because knowing the difference, well, that's everything.
You know, whenever you think about the greatest investors of all time, Warren Buffett's name is usually right at the top of the list. But what if I told you the intellectual powerhouse, the real architect behind his incredible success, was somebody else? Today, we are going to deconstruct the uniquely powerful, and I mean truly rational, investment philosophy of Charlie Munger. So let me just start with that question. If Warren Buffett is the face of Berkshire Hathaway, who's the architect? Who built the mental scaffolding that took a great investor and helped make him a legend? Well, the answer is the brilliant, absolutely indispensable partner we're going to be talking about today.
That's right, meet Charlie Munger. And look, he was so much more than just Buffett's number two. He was the catalyst. He was the one who fundamentally rewired how Berkshire Hathaway thought about investing. Munger's the reason they shifted from buying just fair companies at wonderful prices to buying wonderful companies at fair prices. And how he did that? Well, it's a complete masterclass in clear thinking. Okay, so here's our roadmap for today. We're going to start with Munger as the architect. Then we got to go back and look at the foundation he built on, the principles from his mentor, Benjamin Graham. From there, we'll dive into his two revolutionary upgrades, the lattice work of wisdom and his deep obsession with the psychology of misjudgment. Then we'll see how that all comes together to find businesses with moats, and finally, how you can synthesize it all to become a complete investor. To really get Munger's genius, you have to start where he started, and that's with his teacher, the father of value investing himself, Benjamin Graham. See, before Munger could add his own layers, he first had to become a complete master of the basic rules of the game that Graham laid out. This was the bedrock. Everything else is built on top of this. So Graham's whole system, it really kicks off with this very simple but incredibly profound distinction. First, what exactly is an investor? Well, according to Graham, an investor learns to ignore all the noise, all the daily chatter of stock prices. They are, first and foremost, a business analyst. They're obsessed with one thing, and one thing only, figuring out the true underlying intrinsic value of a company. And then, on the complete other side of the coin, you have the speculator. And their game is totally different. They're not trying to value the business at all. What are they trying to do? They're trying to predict the psychology of the crowd. They are basically betting on what other people are going to be willing to pay for a stock tomorrow or next week, with very little concern for what it's actually worth today. So you see, this is the crucial line in the sand that Graham drew. You have to decide which game you're playing. Are you playing the game of business analysis, focused on real value? Or are you playing the game of guessing human emotion, just betting on the future price? For Graham, everything, and I mean everything, hinged on that distinction. And to really hammer this point home, Graham came up with this brilliant little story, an allegory, about a guy named Mr. Market. Imagine you have a business partner, but he's a total manic depressive. Some days, he's just euphoric. He's so happy he offers to buy your shares for a ridiculous sky-high price. But on other days, he's in a complete panic, and he'll offer to sell you his shares for pennies on the dollar. The investor uses these mood swings. The speculator gets swept away by them. So how in the world do you rationally deal with a bipolar business partner like Mr. Market? Well, Graham's answer was just beautiful in its simplicity: the margin of safety. The concept is this: you do the hard work. You calculate what you believe a business is truly worth. And then you just wait. You wait until Mr. Market, in one of his depressive fits, offers you a price that's far, far below that value. That gap, that's not just your potential profit, it's your protection. It's your buffer against being wrong, against bad luck, and against the madness of the crowd. Okay, so this is the moment where Charlie Munger really enters the story and starts to build on top of Graham's incredible foundation. He takes everything Graham taught him and applies his first revolutionary upgrade, arguing that to really understand business value, your toolkit needed to be a whole lot bigger. Munger called this big idea worldly wisdom. His core insight was that a business doesn't just live in a financial spreadsheet. It's a complex, living, breathing thing that operates in the messy, real world. So to truly understand it, you have to pull in the big foundational ideas from all the major disciplines. Physics, biology, history, psychology, you name it. And the way Munger pictured this was as a lattice work of models. Now the key here is, you don't just collect these ideas like stamps in an album. You have to weave them together in your head until they form this interconnected framework, a lattice work. This framework allows you to look at a problem from many different angles at once, and by doing that, you get a whole lot closer to the truth.
But just building a model of the outside world wasn't enough for Munger. His second, and maybe his most famous, upgrade was his obsessive focus on turning the lens around, on looking inward, and understanding all the different ways our own brains are wired to fool us.
Think about it. Our brains are built for efficiency. To get through the day, we're constantly using what are called heuristics, basically mental shortcuts or rules of thumb. These are the things that allow us to make thousands of decisions every day, like automatically stopping at a red light, without getting totally paralyzed by overthinking.
But here's the problem, and this is the thing Munger just hammered on over and over. What happens when those exact same shortcuts, the ones that make us so efficient, actually cause us to make massive, systematic errors in judgment? Especially when the stakes are high, like they are in investing? That's the dark side of our quick-thinking brain.
And this realization led Munger to a really profound conclusion. For any serious investor, the single biggest danger you face isn't a market crash. It's not a recession. It's the enemy inside your own head. It's our own set of unexamined psychological glitches. So for him, mastering your own psychology is just as critical, maybe even more so, than mastering how to value a business. Okay, so let's say you've done the work. You've mastered Graham's basics, you've started building your lattice work of mental models, and you've learned to be on guard against your own biases. So how do you actually apply all this to find great investments? Well, Munger and Buffett's answer is beautifully simple. You look for businesses with a moat. A moat is their famous metaphor for a durable, long-lasting competitive advantage. It's some kind of structural feature of the business that protects it from competitors, just like a real moat protects a castle from being invaded. This protection is what lets a company earn fantastic returns on its money for years and years, and sometimes even decades. And these moats can take a few different forms. It might be incredible brand power, right? Like that feeling people get when they buy a Coke. It could be really high switching costs, which basically lock customers in. It could be powerful network effects, where the service gets better and better the more people use it. Or it could just be a massive cost advantage that competitors simply can't touch. But here's the catch. And for Munger, this is the most crucial piece of discipline. To be able to tell the difference between a real, durable moat and just a temporary advantage, you have to be brutally honest with yourself about what you know and what you don't. You have to operate strictly inside your circle of competence, which means only investing in businesses and industries you can genuinely, truly understand on a deep, expert level. So now, let's pull all of these threads together. Let's synthesize Graham's solid foundation with Munger's two powerful upgrades to see what this unified framework for becoming a complete investor actually looks like. And here it is, the whole Munger method as a continuous process. You start by mastering the fundamentals from Graham, knowing you're buying part of a business, not just a ticker symbol, and always, always demanding a margin of safety. Then you expand your mind. You build that multidisciplinary lattice work so you can see the world as it really is. Next comes the hardest part. You turn the lens inward and you fight against those cognitive biases that are hardwired into your own brain. You use that self-awareness to define your circle of competence, and you find the discipline to never ever stray outside of it. And only then, after all that preparation, do you patiently hunt for those truly wonderful businesses protected by deep, wide moats.
I want to leave you with this powerful quote from Munger because it really gets to the heart of his entire philosophy. For him, this whole process, it wasn't just some clever trick for getting rich. He genuinely believed that the pursuit of clear, rational, multidisciplinary thinking was a fundamental responsibility. It was a moral duty for anyone who wants to navigate the world effectively and, contribute something wise to it. And that really brings us to our final thought. Munger applied this system to investing and got legendary results, obviously. But the system itself, it's universal. So the real question to think about is this. Where else in your life, in your career, in your relationships, in your big personal decisions, can you apply this lattice work of worldly wisdom to make better choices?